Okay, thanks guys for reading through those disclosures. My name is Natalie Beckett and I'm going to be your moderator for this afternoon's free educational webinar. Today we are excited to host Bubba Horwitz, and he's going to talk to you guys about how to use weekly options. We also have Andrew Aronson with us. He's part of the team over here at AGT. Andy, are you there?
I sure am. Natalie, how are you?
I'm great. How are you?
Great. Is Bubba with us?
Yeah, of course I'm here. What? I'm always here. I snuck in the back door.
Good. Well, thank you for coming on. Go ahead, Natalie.
Yeah, I was just going to say, Andrew, if you want to give a little brief intro on Bubba, and while you're doing that, I'll give Bubba the reins and he can pull up his presentation. For those of you guys listening today, if you have questions during Bubba's presentation, just put them in the Q&A or the chat box, and Andy and I can field those over to Bubba. So, Bubba, if you want to share your screen, and Andy will do a little intro for you.
How's that?
Beautiful.
There you go.
Well, Bubba, I just want to say thank you very much for providing us with free education again. Seems like every 2-3 weeks we're doing a webinar with you, and I got to be honest with you, the feedback we get is phenomenal. They keep asking, when are you going to have him on again? Because he is very exciting and very educational and very informative. So I think everyone's in for a treat today. I'll let Bubba go on from here, but basically don't be shy. If you have any questions, I've never been able to field a question that Bubba couldn't answer. So don't be shy. Go ahead and send the questions to us. We'll interrupt Bubba and ask those questions as we get started. Bubba, why don't you start off by telling them how you got the nickname Bubba? We got a lot of new people here. That's a question I used to ask a couple months ago, but let's start with that, and then without any further ado, the reins are yours.
All right. Well, what's up, everybody? And the name came from Bubba Smith. How many 6'3" Jewish guys did you know in the 60s? And I'm one of them. So I played football, and I attacked the name Bubba Smith. Everybody called me Bubba, and that was my trading name. So that was my badge on the floor, and it's stuck. In fact, I don't think anybody knows my real name anymore. So it works out perfect. So anyways, what's up, everybody? Welcome aboard. It's always great to be here, and we're going to talk about how to trade weekly options. But before we can get started, I have to let you read this disclaimer real quick. Options involve risk and all that stuff. I'll give you about 10 seconds to read it, and then we'll get rocking and rolling here and fire up. Okay, good. That's good. So I am Todd Bubba Horwitz, and I've been doing this for 38 years. I did start out at the CBOE in 1980. I'm now still currently a member of the CME or Board of Trade, whichever you prefer. I'm the founder and author of Bubba Trading, Bubba's Guide to Trading Weekly Options. I'm also a regular contributor. In fact, I just jumped on Fox before I came on here. I'm doing CNBC tonight. If any of you get CNBC Asia, you can watch it at 9:10 Central Time. And I do Phoenix TV at China, no tariffs there, and Kitco News. I also have my own radio show every day from 4 to 5 Eastern, and I was an original market maker in the SPX, which you know as the S&P. These are the two books that I've written, and this handsome guy here, that's October 19th, 1987, In the Pit, a picture that was taken by Time Magazine. But let's begin, and today we're going to talk about trading itself. It's a game of skill. We're going to talk about the 10 Commandments, the mathematics of trading, discipline, the phases of the markets, options, and the weekly options. And we'll give you some strategies, and we're ready to rock and roll. So, trading itself is a skill game. Okay, it's not a luck game. It's not a fundamental game. It's a game of skill. It's understanding the markets themselves, how they work, how they function, but it always comes down to math. That's what we're always focused on, is the math of the market, because markets will give you a solid footprint based on what's been showing in the charts, very much like gin, backgammon, poker, or bridge. Those are all games that the better player will have the edge. Well, the better trader will get the edge. In that, the way to be the better trader is to understand how the markets work. So that's what we're going to focus on today and get you through, so you can be prepared to be exciting and understand what's going on, so you can make the right decisions. Now, all decisions won't always work, but you'll always have the probability edge, which is all we can ask for. Now, the 10 Commandments of trading, okay, the first is you always have to protect your capital. All right, that's the number one thing. That is your inventory. If you're in business, you're always protecting your capital. Always set a stop loss. All right. Now, I don't always set stop loss if I'm talking to people about it, because I watch them myself. But if you're just going to put an order in and you're not going to be able to watch, you must have a stop loss. Cut your losses short. Let your profits run. Trade what you see, not what you think. We all have a tendency to let our opinions get in the way of what we think and what we see. That's never a good recipe. Never chase your losses. Just because you're a probability edge doesn't mean that the next trade is going to be better. You have to continue to be consistent in how you trade. Never average down. Keep good records so that you can go back and look at a trade to make sure that you were doing the right things. Maintain your discipline. Keep it simple. Plan your trade and trade your plan. And I teach this and tell this to everybody. You've got to have a trading plan. And if you're doing more than one type of trading, you've got to have more than one plan. The planning and the understanding of what decision you're going to make before you make it, you should know. And that's very important to all of you, is to know what you're going to do. You should know what you're thinking about before you get in the trade. And once you enter, you should know what your exit is. Remember, when you get in an airplane, what's the first thing the pilot tells you? Where the exit doors are. Now, we talk a lot about the math because really trading comes down to numbers. It comes down to standard deviation moves and things like that. When a stock or a future or any of your trading options on gets too far extended one way, more than likely it's going to come back the other way. That's why anytime if there's a big sell-off overnight and people are panicking, and I say just relax, the markets will correct a little bit. They'll come back to you. Now, how far, we never know, but we know that this math will work. And we look at strategies like too far, too fast. We look at strategies like well overbought, well oversold, because those are giving you, again, a mathematical edge. And if you've ever looked at the Bollinger Bands, that's what they're designed off of. They're based off of a 2 standard deviation move, which is unusual in markets. You don't get too many of them during a week or a month or a year. You know, they come, but when they come, you have to be prepared to act on them. And that's why we always say that this game of trading is always about the math. In fact, if you look, I always do a little impromptu while I'm here as well, so I'm going off script for a minute. If you look here, this was a 2D move going up, and the markets did sell off. In fact, I texted somebody this morning saying, this is probably the top of the spiders for a little bit. So again, when you look at that, make sure you recognize it. You don't want to try to be too early. You'd rather wait until the market turns in the direction that you're looking for, and we'll go into that with the phase of the market a little bit. Discipline is the whole key, okay? It's being able to say, I'm wrong, I need to get out, I need to take my losses, I'm right, I'm going to learn how to make these things run. I have to use the tools that the market gives me. The market provides you very solid instructions if you pay attention to them. And that ties into what we call the phases of the market. Okay, the markets themselves go through 3 basic phases. We call it universal price. All right, because in my eyes, all charts are the same, all patterns repeat themselves. The shortest time frame always has to resolve itself into the longest time frame. So if you look at that and you start to understand, so here we're looking at a market. Now here was a market that was in consolidation. All right, so from consolidation, that's a series of double tops and double bottoms. The market is going to break out. It's going to either break out up or break out down, but it's going to break out in one direction. Okay, so finally, after a couple of months of consolidation, the market broke out to the upside. Then it consolidated on top and held the support level. Okay, and then it finally, yesterday and this morning, had what we call a blow-off. So you go from congestion to break out the blow-off. That goes for both directions, and it goes on any time frame. So we just narrow this down to a 4-minute time frame, which I do a lot of trading on 4 minutes. You'll see where we had 2 mathematical moves in the afternoon that the markets broke hard down, which if you're trading in this short of a time frame, were a potential buying opportunity. The close was a potential selling opportunity. Down in here was a potential buy. I didn't make any of these on this product, so I'm not going to say that these are trades, but these are things that you're looking for when the markets blow off. So if you look at what we just looked at, consolidation, the markets broke to a trend, and then finally they broke down and just blew off to the downside, which is usually caused by panic and fear, like greed is caused to the upside. That's an opportunity, okay? And that's what you want to put yourself in. If you're going to use these type of strategies, these are the things you want to understand. And what we use is we use a secondary time frame to go with it. So if I was going to look at this and possibly trade this here, what I would do is I would look at the 4-minute, see the pattern developing, and then I would flip over. Once I saw the pattern, I'd flip to the 1, and then my buy point would have been somewhere up here if I would have bought it. I did not. I did not make this trade, but that's where I'd be looking to buy once the 1 minute confirms that the bottoms are in. And that's kind of the things that we look at, but that is what we call the phases of the market. All markets do it. All patterns do it. All time frames do it. It doesn't matter whether you're looking at a daily, a minute, or if you went out to the max of this chart, which is 20 years or so, on a monthly basis. The same patterns keep appearing over and over again. And that's what you want to learn to recognize, is we call it pattern recognition. Now, the history of options options have always traded. I mean, you can go back to Tulip Mania, you can go back before that. There's always been some form of options, but in 1973, the CBOE launched the exchange, okay, and they started out with just quarterly options. What we know today as the triple witching cycle was what the CBOA started out with, which is March, June, September, and December. That was also became known as triple witching. We then went to monthly options and quarterly options, and then finally we went to weekly options. Okay, in fact, the S&P, the spiders have 3 expirations a week, but the weeklies really brought the edge back to retail and gave us a better chance at these markets, because if you understand them, they're very powerful to use. And they give you a great opportunity to do many different things. We'll go over these strategies in a couple of minutes. Now, they started out as 8-day options. They used to open them up on a Thursday, and they would expire the following Friday. Now, if you're familiar with these at all, you'll have multiple weekly expirations on many different products. If you look at the spiders, okay, you've got June 8th, June 11th, June 13th, June 15th, 18th, 20th, and their weeklies go all the way out until September, basically. All right. Apple doesn't have quite that extensive, but Apple has a bunch as well. And you can see that they now are just trading because what they found is that these are a great trading vehicle. This is something that you can actually use as an investment. You can use as a possible hedge. You can use as a straight-out trade. There's so many things you get, and what we do know is that every Friday, these options expire. Okay, so they either are worth something or they get abandoned as worthless. Now, the big thing, if we remember time decay, okay, on a quarterly option, time decay really kicks in the last 30 days. On a weekly option, you're at the risk immediately to time decay because you don't have as much time. Remember, the volatility behind the market gives you the timing and the price of the option. Well, as you get away in price and you get closer in time, the probability or the likelihood of that happening becomes much less. That's why when you're doing this, you have to have a specific spec reason that you're getting into this trade, whether it be a 2 standard deviation move to the downside, whether you see some sort of a double top, whether you're trying to play a news item, whatever you're trying to find out, you've got to understand that these are going to decay fast. So the returns are much bigger on the weeklies, but so is the time decay. So again, that's why you're also paying less money. But when you learn to understand, which we're going to cover right now, statistical volatility and implied volatility. Now, statistical should only be used as a guide. Okay, statistical is what is it traded in the past. All right, so we'll look at the past because I want to know how much volatility any one stock can support because they're all different. Now, I don't know if you've ever made this trade, but I know many have, where you've bought something or sold something, you bought a call, you bought a put, and you were dead right, but you didn't make any money. And you know what that means. It means that you overpaid for volatility. Volatility is ever changing in many different stocks, but they do find a level of where they belong. So when you look at the implied volatility, so let's go out to July because I want to give it some time so you can see. If I look at the implied volatility in the spiders in July, okay, you've got about a 17% volatility, okay, in July. That gives us an approximate move, an expected move of almost $10 in the next 43 days, up or down, okay? But what this means is this is how they price the actual option based on the volatility. Now, when you look at volatility, I happen to know that the spiders have troubles at 20 or higher of carrying those prices, and they typically trade somewhere between 10 and 15. When they get down below 10, that's usually when volatility is going to pop. But the difference is when you look at different stocks. So if we look at the spiders, I'm sorry, I'm looking at Apple. That's the problem. I'm talking about the spiders. How about that? I knew something didn't seem right because this should be about 12. There we go. Now this is better. This is more better. All right, sorry. This is 8%. So this move is still $10 because it's based on the stock. But when you look at this, this is the time that you should be looking to buy volatility because it's not going to go much lower. Now, it may not go up, but it won't go much lower. But volatility moves option prices, whether the stock or the underlying moves or not. So if you look at this at 8.5% volatility, and if we switch to Apple, so we've got $2, the 278, the 277 is about the at the money. So they're trading at, let's say, 362. So a similarly priced stock, this would be, let's say, Tesla. I'm going to go to the other end of the extreme. So Tesla, in the same period of time, is looking at the at the monies are about the 315. They're almost $19. Why? Because volatility is 5 times higher. So it has nothing to do with the underlying or the stock. It's got everything to do with the volatility that's put in there. And this is a very misunderstood because when you get close to earnings, okay, volatility starts to pump up into these. So you got to be very careful. That's where the statistical volatility shows up, because if you understand what the typical volatility for that stock is, and it's well over that, then you're probably not going to be in good shape. In fact, there's an old story back a number of years ago when Google was going to have earnings, and they were going to have boxcar earnings. And everybody knew it. And everybody was buying calls. And before you knew it, the implied volatility was so high, the stock did have great earnings. It did go up $60, and everybody who bought calls lost money because they were so overinflated. You look at volatility as a balloon with the air going in and out of it. Well, this balloon was so exploded that it didn't matter. You couldn't price in enough, because what you have to remember is everything starts from the at-the-money option or the at-the-money straddle, all right? That's where the market's trading. So if you buy something going to earnings, I think MU is next week. I'm just going to give you a quick lesson here. I believe MU is the week of the 15th. Maybe I'm wrong. Okay, maybe I'm wrong. Well, anyways, we'll look at the at-the-money straddle. So this at-the-money straddle, the 59.50 straddle, is trading at 314. Okay, so that means that if you buy this straddle, the stock's got to move $3.14 for you to break even, because you're gonna gain and lose on one side or the other. Now, if volatility doubled to 88%, oh, here's the earnings next week. This is better.
It's on the 20th, Bubba.
Yeah, I see it. I can see by the volatility. See, look at this. If you're looking at my chart here, you can see 44% for next week, 63%. So immediately, if you see that, you know that something is wrong. Okay, not necessarily wrong with the market, but something is going on. There's going to either be an announcement or something of that nature that week. So sure enough, that week I happen to know it's going to be earnings. All right, so the 59.50 straddle for that week is $6.18. Okay, which means that the stock is pricing in a little bit over a $6.20 move, and of course there it is. It's pricing to $6.34. So this stock, if I were just to buy the straddle, has to move $6.34, and this is overinflated by 50%. Probably not a great buy. These would be options that we would be selling against another position if we were going to do so. But understanding how volatility changes the price is very important, because when they get too full of air, it's very hard to make money buying premium. That's one of the big issues that everybody has to understand. Now, advantage of weekly options are, if you're the buyer of options, the weeklies give you the opportunity to pay for what you need. Now, again, you can make, if you're going to be right, you make the most amount of money on weekly options percentage-wise because you're giving up the least amount of edge. You're paying a premium for them, but you're not paying as much premium as if you're going to carry out into time. So the advantage there is that you can pinpoint exactly where you want to go, and you can benefit immediately if you're right. Now, if you're wrong, you're going to lose some money, but at the end of the day, you're not giving up that much, and then you can reevaluate on a weekly basis if you still like that trade. That's something that you need to look for. If you're a seller of options, then you're speeding up time. But now if you're a seller of options, obviously everybody knows that we're in a shorter period of time, so you're not getting as much premium. But I'd like to get, if I'm a seller of spreads or something like that, I like to get 40 cents per dollar when I'm selling a call or a put spread. And I like to get 80 cents on a $2 wide iron condor if I'm going to do that. But it allows you to reduce short-term costs. It allows you to go in at the market right away, and it allows you to advance your strategies depending on what you're trying to do. If we feel that volatility is going to pick up, we might use one strategy. If we feel that volatility is going to fall, we might use another. So there's a lot of ways to use this, and you have to be careful here, because when you start doing, like butterflies or iron condors or other elaborate strategies, you have to make sure that there's going to be enough volatility to make those move enough to cover all your costs. So it's a very important thing to understand. Now, the disadvantage is they are expiring very quickly. So if I buy, I will sometimes buy options today for tomorrow. All right, just if the right setup comes, because I'm paying virtually nothing, all right, and I can get into a trade, and if I'm right, I'm going to get paid. And if I'm wrong, then I'll lose a little bit of money. But again, just for example, back to our spiders, if I wanted to make a trade for tomorrow, June 8th, all right, now let's just say, for example, I thought the stock was going to go up. I could buy the 277.50 calls, which have 13 cents of intrinsic value. So basically, I got 46 cents that I'm investing in here. Okay, if I'm wrong, so I'm going to lose 59 cents. But if I'm right, I'm going to get paid dollar for dollar once it gets into the money, because I don't have to worry about all that extra time decay. I don't have to worry about a volatility crush. When you get the expiration, you're getting direct goods, right? And that's something that is important. Now, we actually bought today, just a quick story, we bought the VIX options, okay? We bought the 3250s for next week, okay? They're trading 116 to 125. We paid 105. They went to about 188 today, okay? Because we had a plan that we were looking for. So it's something that you always want to look for when you're trying to lay out your plan, right? But you have to make sure, again, that if there's some kind of announcement coming out, you want to be very careful, because you don't want to pay that inflated volatility. Everybody believes you can just buy like a straddle for earnings, and you'll find out that more often than not, you will lose money when you make those types of trades. Now, trading strategies that you can just buy a call, you can just buy a put, you can sell a call, sell a put. Now, I'm not a big naked seller. If I'm selling, I usually sell spreads. You can buy spreads. I very rarely will buy a debit spread. I'll sell credit, because I believe that the risk reward is the same, but I don't need the same kind of movement. But these are strategies that I like to use in these very short-term expirations. I don't want to get caught up with too many different things that I have to do to get involved. Now, if I'm playing an announcement, I could use one strategy. I would never buy a straight-out call or a straight-out put if I was playing for an announcement. I would have to set up some sort of strategy to make sure I could benefit but also cut down the risk, which would be using a butterfly spread. Now, typically, butterflies can be straight butterflies if you know what they are, and if you don't know what they are, you can also use weighted butterflies, which puts you leaning to a side one way or the other. You can sell iron condors, you can do double calendars, you can do call or put calendar spreads, and you can do diagonals. Now, if you're using the diagonals or the calendars, you're trying to create almost a synthetic covered call or covered put strategy that allows you to try to collect premium off of a move. So basically, what we use when we use diagonal, we would buy them where they are and sell them where we think they can go, trying to capture that premium while staying in the market. But all of these strategies, again, can become costly, because they're expensive to put on, and you've got to make sure that you understand how to get in and out of them. But there's a lot of strategies that you can use in a very short period of time. Like we've been using recently, the last couple of weeks, we've been using, believe it or not, a Friday, Monday calendar in the S&P, just the spiders, okay? Because we can do that for, about 20 cents, and it's a chance, you've got a chance for a big move with only 20 cents worth of risk, which is what you always want to put yourself in a position to have big potential profit with very little bit risk. That's the whole key to success in trading. And using these different strategies, and that's where you want to understand these strategies. You should always use limit orders on your trades. Market makers are not going to fill you at great prices or wide markets when you do not use limit orders. Now, again, everybody says you should never trade on the opening. Well, I'm going to say to you that it's fine to trade in the opening. If you're setting the price that you want to set, then it doesn't matter. You get filled at your price. But if you put in a market order, you can have, especially if the stock is not as liquid as it should be, you could have some bad action happen to you. And you never want to be in that position. Even if you wanted to pay the market, my recommendation to you is to put an order in at the offer price, which is like paying the market, but don't leave it to somebody else's discretion. When I trade options with companies reporting earnings, I only risk 1% of my portfolio. That means on a $10,000 portfolio, I only risk $100 a trade, even if it means I can only produce one contract. Again, sizing your positions is very important. They should be sized based on the account size that you're trading with. Don't outsize yourself in this market, because you want to have the opportunity. Remember, we've got 52 weeks in a year. So you're going to have opportunities in thousands of stocks that you can make trades in. So don't put yourself out of business by trading too big. When trading weekly options, time and price are of the utmost importance. Unlike stocks, there's a ticking clock. Again, the decay factor continues, and you don't get a benefit. Okay, we're giving up that slight edge to risk less, but to make more percentage-wise. You need to study these different strategies, and you need to study what you're trying to accomplish. You have to have this is all part of your trading plan. You need to be ready and planning yourself so that you understand what you're trying to get. So if you look at, I'll just give you another trade just real quick that I made so that I can actually talk about it. AMBA, Alpha Michael Bravo Alpha. Okay, so this had earnings on Tuesday, I think. All right. So I was actually long for earnings, all right, and I was wrong. But I immediately also then bought on what I call the too far, too fast, okay? And we're getting a little bit of a pop here. And there's a chance it could pop all the way back, but we actually bought the calls for next Friday, June 15th, because to me, the math says that I'm in an advantageous position here to buy that. Right? Just like on my Monday call, we were selling up here at 55. So again, that's what we're looking for, is where we can gain and gather an edge in when we're trading. Okay, so weekly options buyers should avoid sluggish stocks. Again, you're not going to trade Coca-Cola or Bank of America on weeklies. They don't move enough. You're never going to have a chance. You have to trade stuff that's got some volatility. You're going to wait for the right setup. Okay? You know, again, you in this business, you have to have the patience enough to wait for it. Look for a potential catalyst, either too far, too fast, which is what I look at sometimes, or look for a market congesting, look like it's going to break out, and then I think it's going to break one way, so I'm going to go with that way. All right? Focus on liquid stocks with narrow bid-offer spreads. All right? Because if you get into these wide bid offers, it's hard to overcome a large bid-offer spread. So you want to look at, like, the spiders are the ideal because they're like 1 or 2 cents wide. But you want to make sure that the stock that you're playing can give you enough movement to overcome the things that you have to give up. So that's very important. So you want to put a good list together that you can watch. I mean, I have a list that I watch, and this is my list right here. Okay. Apple, ABB, AMBA, Amazon, so on and so forth. Now, these are all liquid stocks that trade. So I know that if I'm going to get in one of them, I'm going to be able to get some movement. Now, I like trading weekly options on the blow-off pattern. So if you remember those phases of the market, when the market blows off in either direction, I don't care. I'm going to try to pick the top or the bottom. But I'm doing it based on a mathematical edge, not based on my opinion. So I'm going to look at that shorter-term time frame. I'm going to see that blow-off, and then I'm going to either buy a call or buy a put. Because based on what's happening, the market should give me some bit of a reversal pattern. And even if it's for a short term, if I could double my money, that's not a bad trade. But those are things that you're looking at. Earnings trades. Okay. If you want to trade during earnings, there are strategies like a back ratio spread or a broken wing butterfly. And if nobody knows, I'm going to just show you what that is. Just I've said it a couple times, and I probably should just explain it real quick so everybody knows what it is. Okay, so if we want to do a trade here, and I'm going to set it up as a condor because I have to customize it. So if I want to do a trade here, maybe I want to do what we call a broken wing butterfly. Okay, so here I would sell the 277.50 call. I would sell the 277.50 put, and then I would buy, let's say, the 278.50 call, and I would buy the 276.50 put. So I can do that trade straight up for a credit of 4 cents, which I don't want. I want to make it. I want to weight it because I want it to. Excuse me. Okay, I want to weight this because I want to benefit from either direction. This is a weighted butterfly, okay, that I can do for a 27-cent credit tomorrow. Now, I need a $1 move to overcome, but in the meantime, I've got this set up with the maximum risk on this trade is 73 cents, okay? Now, I would use this trade, though, and when I know there's going to be an announcement, I know there's going to be a big move, I can then exit one side or the other if the big move goes and big enough to get me out and make a profit, and then I can hold the other side of the trade. Now, if you want to do this as what we call a broken wing, let's say you wanted to be short, then you could do it like this and be long one extra put and flat the spreads. So you'd be short a call spread and long a 1x2 put spread out of this, what we call a broken wing butterfly. Now, these can be adjusted into condors, broken wing. There's a whole bunch of strategies, obviously. I can't teach them all in this short period of time, but these are things that you can use. But before you use any of them, you've got to understand how the option model itself works, how volatility works, and how the charts work and how the markets work. You can also use weekly options to hedge. Now, you can hedge your portfolio. You can hedge your position. There's a lot of things that you can do. I mean, we use a longer-term option for what we call an anchor position, and we sell weekly options against the longer-term position, trying to generate yield. So there's a lot of different strategies that you can do. As they say, the opportunities or the possibilities are endless. Right? You have things you can do by trading in a very short period of time. You're cutting down your potential risk exposure over the long haul. Weeklies also give you the opportunity to what we call roll up your position. If you bought a stock that you liked and it was going in your favor, and you get to Friday, you go, gee, I still want to be in here. You can sell the one you have and then buy the one for next week. You can continue to roll them over until until it's time to get out. At the same time, taking and locking in profits as you're rolling along. So these are things that you need to be aware of so that you can put yourself in the best position. And again, it really comes down to the patterns that you decide to identify in a market. I personally like what I call the blow-off pattern. In fact, I thought that last night in the Dow was a blow-off on a longer-term market. Now, it did not work out. It continued to go higher. But I would consider this another opportunity that this is blowing off, and I can see that the volume is picking up. So you want to look at the little things that make a difference. If you get very large price movement in a very short period of time on heavy volume, that would be considered a potential blow-off pattern that you then would want to fade or go the other way from the way that's moving. Because if you look in the shorter term time frames that we'd be looking at to try to trade these, for example, this morning you can see this big blow off to the upside. And what happened? It came all the way back down, and it actually formed a V pattern. So you had, actually, if you're trading this, you had a couple of opportunities to do this. But this is what you're looking for. You're looking for something that's going to trigger your trade and put you in the next position to move on forward. Andy, is there any questions for me, young man?
Yeah, we have a couple questions. Are you finished?
Yeah, I mean, I have a little bit more, but I just want to make sure I get them all because I know I'm on I'm on a time scope here. I only get to 4:15, so I don't want to leave anybody out.
No problem. I got a few questions here, but can you go to your contact page?
I can.